Hi, good morning, everyone, and thank you so much for joining us here today at our ETF Festival 2024. My name is 𝗪人. I'm part of the research team at iFAST, and today the focus of my presentation is actually on this year's edition of the ETF Focus List. So some of the things that I'll be covering in my presentation will be specifically on our selection methodology. How do we go about selecting the ETFs for our focus list? I'll also be sharing with everyone how you can make use of this focus list to help build your investment portfolios. So just a bit of background information on our ETF focus list. So we first introduced our ETF focus list in 2018 with a single purpose, which is to help guide our investors through the thousands of ETFs that are listed on our platform. So using our selection methodology, we actually condensed nearly 8,000 ETFs on our platform into a more manageable list of around 50 ETFs. And this actually serves as a very good starting point for investors who are looking to build a diversified portfolio with low-cost ETFs. And to also ensure that our recommendations are always relevant and up-to-date, we actually refresh our ETF focus list every year. So this year is no different. We've actually reviewed our ETF focus list. We have changed a couple of recommendations. And I'm happy to share with everyone that there are a total of 47 ETFs on our focus list this year. So a very simple but very important question is, where can you find our ETF focus list? So on our website, under ETFs, you can find the ETF focus list. And that's where you can find the 47 ETFs that we recommend. If you're accessing our website using your phone's web browser, then you can also find the focus list easily by simply going to the menu, followed by ETFs, and you should be able to find our ETF focus list. If you have the mobile app installed on our phone, you can also access the ETF focus list by selecting ETFs on the home screen, followed by the ETF focus list. And you can also see from on this particular screen that our ETF focus list is actually organized into 6 different categories, from core equity, fixed income, all the way down to tactical plays. So after my sharing today, please feel free to check out our focus list and also check out the 47 ETFs that we have recommended to our investors. Okay, so how do we select these 47 ETFs for our focus list? In a nutshell, we actually look at 3 key quantitative factors: expense ratio, the tracking difference, and the liquidity. And of these 3 factors, I'll say that expense ratio is arguably the most important of the 3 factors, because even though ETFs, they are already low-cost investment vehicles, they still come with a cost. And this cost could potentially eat into your returns in the long run. Now, one thing that you need to remember is you, as an investor, you have no control over how your investments are going to perform in the long run. Okay, you have no control over the direction of markets. But what you have control right now is your investment cost. The lower your cost, the greater your share of your ETF's future returns. And the lower it is, the better it is for the investors. So expense ratio, for us, that's arguably the most important factor. Tracking difference is also something that we look at. So ETFs, they are an investment vehicle created to track the performance of an underlying index. So how do we know whether this ETF is doing its job well? We look at the tracking difference, which is essentially the difference between the performance of the ETF and the underlying index. So if, for example, the Straits Times Index goes up by 5% today, you would naturally expect your STI ETF to also go up by the same magnitude. But if for some reason the ETF goes up by only 1 to 2%, then I think serious questions need to be asked about the replication method and also in general the investment strategy of this particular ETF. So ideally, the tracking difference of that ETF, it should be as low as possible. And of course, ETFs, they are exchange-traded products, which also means that liquidity is an important consideration as well. And generally, we tend to prefer ETFs that have higher volumes and ETFs that have smaller bid-ask spreads. Besides quantitative factors, we also look at some qualitative factors. So one of the things that we actually look at is actually the choice of index. We want to ensure that the underlying index of the ETF is actually a good representation of the market or the sector that the ETF is intended to track. On top of that, we also look at the structure of the ETFs. So the majority of the ETFs out there, they are what we call physical ETFs, meaning the ETF replicates the performance of the index by buying up the actual securities that make up the index. So these are your physical ETFs. But there are also another kind of ETFs, another breed called your synthetic ETFs. So these are a bit different from physical ETFs because they make use of derivatives to replicate the performance of the underlying index, which also means that synthetic ETFs in general, they are exposed to counterparty risk. For us, if there are two ETFs, one synthetic, one physical, and these two ETFs are very comparable in terms of cost, tracking difference, and also liquidity, then our preference is actually to just go for the physical ETF because of the limited counterparty risk. Listing location. In the past, listing location is actually more of a minor factor for us because back then we didn't offer LSE trading. Okay, but this year is different. We now have LSE ETFs on our platform. So the listing location suddenly becomes a very important factor because the issue of withholding taxes, that's top of our minds in our ETF selection. So that's something that we also consider in our ETF selection process. But one thing that I'd just like to highlight to everyone is just because LSE ETFs, they have a tax advantage, it doesn't always mean that they are the best choice for you because that is only one of the many things you need to look at when you assess which ETF to buy. The withholding tax advantage is only one factor. There are other things you need to assess. Okay, you need to assess the trading fees involved on the various exchanges. And importantly, you need to look at the bid-ask spreads. US-listed ETFs in general, they have superior liquidity compared to your LSE ETFs. You just need to ask any of your friends who are traders. Okay, they are mostly active on the US exchanges. They rarely play the LSE market because the liquidity on the US exchanges is a lot better, which also means the bid-ask spreads that you're getting on the US exchanges is a lot better compared to the LSE versions of the ETFs that you're looking at. And in very simple terms, it means that you're more likely to get a better price for your ETFs trading in the US market compared to the LSE, where you're more likely to be paying a premium above the market price of an ETF. Okay, so that's how we select our ETFs in a nutshell. And over the next few slides, I just want to also share with everyone how you, as an investor, can make use of the ETF Focus List. So many ways. You can actually use it to construct a portfolio from scratch. You can use it to further diversify your existing portfolios. And you can simply just use it to generate investment ideas as well. And over the next few slides, I'll be going through each of these examples and also at the same time, share some relevant ETFs from our focus list that you can consider for your portfolios. Now, if you are new to investing, you can actually use our ETF focus list to construct your portfolio from scratch. And I've actually shortlisted 5 ETFs from our focus list for your consideration. So just now during the poll, some of you here said that you have no experience investing, you are starting out for the first time. So if that's you, okay, this slide is for you. Okay, if you don't know where to start, if you don't know what ETFs to buy, then these 5 ETFs are actually your starter pack. Okay, just focus on these 5 ETFs first. Okay, don't listen to people who tell you that a well-diversified ETF portfolio needs to have many ETFs inside. Okay, it's not always the case. You can actually have a decent portfolio with just 2 to 3 ETFs. And you can actually just pick 2 to 3 ETFs from this list of 5. For example, you can just have a global equity ETF, such as the Vanguard Total World Stock ETF, or you can actually just buy the US equity market by using the Vanguard S&P 500 or the JP Morgan US Quality Factor ETF. And then you pair your equity exposure with perhaps a fixed income ETF, such as the global fixed income ETF by iShares, or if you prefer to have just exposure to Singapore bonds, you can actually just buy the one by Nikko AM, which gives you exposure to Sing dollar investment grade corporate bonds in Singapore. Okay, the downside of this very simple portfolio is that you'll likely get a portfolio that is quite skewed towards the US market, but that's okay. It's okay because the US market is the largest stock market in the world. And the largest companies, the highest quality companies, they are all listed in the US. So if you are a new investor, I think the US market is actually a very good starting point for you. And the usage of ETFs actually gives you very easy access to a diversified portfolio of companies from different industries and also many different stocks and bonds just by using 2 to 3 ETFs. So our recommended global and US ETFs, and as you can see from this screen, is actually the US listed ones instead of the LSE. The reason for that, the reason for our choice really is because of the much better liquidity and beta spreads that is being offered by the US listed ETFs. So much so that it actually outweighs the tax advantages being offered by the LSE alternatives. So at this point, I just wanted to highlight one particular ETF that you can consider for our portfolios. That's the JP Morgan US Quality Factor ETF. So when we think about the US stock market, so the first index that comes to mind is actually the S&P 500. But the small issue with the S&P 500 is that even though there are 500 companies inside the index, the index is actually just dominated by a handful of companies. Primarily the Magnificent Seven group of big tech companies, which actually makes up about 1/3 of the S&P 500. So if you're concerned about this amount of concentration in just a selected few companies, and if you're just looking for a more diversified option for your US equity market exposure, then I think this particular ETF, the Quality Factor ETF, ticker code JQUA, it's a good option for you. As the name suggests, this is an ETF that invests in the highest quality businesses that are industry leaders in their respective areas, and they also come with strong balance sheets. So in other words, these are companies that can last for a long time. They prosper during good times, and they are also very resilient during times of crisis. It is also a lot more diversified, okay, as you can see from the holdings. Top 10 holdings is about 20% of the portfolio, and the Magnificent Seven stocks only makes up about 11% of the entire portfolio. So it's very diversified, and these are also companies that are generally those that have leading market share, high profit margins, and low debt levels. So if you're looking for an alternative to the S&P 500 ETF, I think this is a good option for you to consider. Okay, so now that you have a portfolio, okay, if you are just looking out for more options to diversify your existing portfolio, you can also make use of our ETF Focus List. For investors whose portfolio is highly concentrated in Singapore stocks, I think my advice to you is firstly to look at the US market. But if you already have quite substantial US exposure inside your portfolio, okay, then this slide is for you, okay? You can take the next step, which is to diversify your portfolio beyond the US to include other geographical markets as well, such as Europe, Japan, Asia ex-Japan, as well as emerging markets. And for each of these markets, we actually have a recommended ETF on our focus list. So these 5 ETFs are certainly good options for you to consider if you want to further diversify your portfolio. So one thing that I just wanted to highlight here is for some of these ETFs, they are actually new recommendations, which means that we did not include those ETFs in our focus list last year, but they have been selected for our focus list for the first time this year. So one of the ETFs that we have selected for the first time this year is actually for our Japan ETF category. So last year, our recommendation was actually the US listed iShares MSCI Japan ETF. But this year, we've actually changed our recommendation to the one by Xtrackers, the Nikkei 225 ETF, which is listed on the LSE. So the reason for that is really because the Xtrackers ETF is significantly more cost-effective with an expense ratio of just 0.09%, which is significantly lower than the one by iShares MSCI Japan ETF of about 0.5%. So just by making the switch from iShares to Xtrackers, you can actually save about 0.4% in ongoing annual fees. I've also listed some other notable ETFs that give you exposure to Japan's equity market, but are not included on our focus list because these ETFs are also very cost-effective. For example, the Amundi Prime Japan ETF with an expense ratio of 0.05%, which probably is the lowest across all Japanese ETFs. The downside is that this is an ETF that tracks an index that is relatively unheard of which is why we have actually excluded it from our focus list. But if you just want the lowest cost option, this is it. And also another one for you to consider, the Amundi MSCI Japan ETF, are also very cost competitive. So if you just prefer exposure to the MSCI Japan index, then this Amundi ETF is something for you to consider. But if you just don't know which ETF to buy, just stick to the X-Trackers Nikkei 225. Okay, another new recommendation on our focus list is actually the Amundi MSCI Emerging Market ex-China ETF. So this ETF is actually not a replacement for our existing emerging market ETF. If I can just go back to a couple of slides. Okay, so you can see that our recommended ETF for global emerging markets is actually the one by Vanguard. Okay, that still remains our recommendation. This Amundi ETF that I'm talking about is actually a new category called the Emerging Market ex-China category, and our recommendation for this category is this Amundi ETF. So why is there a need to create EM ex-China category? I think one of the issues with emerging markets nowadays is the dominance of Chinese equities within the overall emerging market index. In the past, that wasn't really an issue because China was doing well, and also the belief was that as China continues to reform and open up its economy, it's just a matter of time before China's economy overtakes the US. So it's a very exciting story, and I don't think anybody had issues with China dominating the EM index. But you fast forward to today, the situation is actually very different because China's economy is heading in the opposite direction. It is now more top-down, it is now more state-directed, and at home, it has a huge economic mess that it needs to clean up, and on the global scene, geopolitics, rising tensions, that's a big source of uncertainty for investors who are holding on to Chinese equities. Which is why we believe that there is now a case for investors to have an EM ex-China strategy inside their portfolios because that there is some flexibility for investors to control their China exposure within their portfolios. So if you are an investor who just want EM exposure, you want EMs like India, Taiwan, and Korea, but you don't want China inside your EM ETF, then this is an option for you to consider. For those of you who want to invest in China, you can also buy this ETF because what you can do is you can have this ETF as part of your core holding. If you're positive on China, you can just buy a separate China ETF and add it to your portfolio. And once you think China is probably not as attractive again, you can just sell it. So you can buy and sell out of your China exposure without having to touch the rest of your EM exposure. So it gives you greater control over your risk and also your overall China exposure within your portfolios. So this ETF, I think, is something probably interesting for some of you. Okay, so if you are on the lookout for money-making opportunities, so now you think you have a portfolio that is quite diversified and you just want to look out for the next money-making opportunity, you can also come to our ETF Focus List and use it as a source of idea generation. So on this slide, I've actually listed down some of the markets that our research team is positive on. Japan, digital economy, semiconductors. We are also positive on Korea because its economy is highly sensitive to semiconductor demand. So it will be one of the key beneficiaries of the AI revolution. Singapore as well, we will be one of the beneficiaries of the upswing in semiconductor demand because of our role and involvement in the global semiconductor supply chain. But I think more than that, Singapore, it has been a key beneficiary of the rising geopolitical tensions between the US and China. So, and for each of these markets and sectors, we also have a recommended ETF. And I'll just, again, like to draw your attention to some of the changes that we have made to some of these categories. So we have made changes to our recommended ETFs for South Korea and Taiwan. So last year, our recommendations for both markets were actually the iShares ETFs. But this year, we have actually switched our recommendations to the one by Franklin. Main reason is because of their much lower expense ratios. You can see very clearly on this line, both the iShares ETFs, they come with an expense ratio of 0.59. But if you look at the Franklin one, it's 0.09% for the South Korea ETF and 0.19% for the Taiwan ETF. So significantly lower expense ratios. Another notable change is our recommended Singapore Equity ETF. We have actually switched our recommendation from the SPDR Straits Times Index ETF to the Nikko AM Singapore STR ETF. Again, because of cost. So from this year onwards, Nikko has actually decided to cap the expense ratio of their ETF to just 0.25%. So last year, Nikko was actually the more expensive option compared to SPDR. But with this recent move to cap their expense, it now makes them slightly cheaper compared to SPDR, just slightly cheaper by 0.01%. So it seems like a deliberate decision to try to undercut their rivals. But whatever the motivations, whatever the reason is, the ones who will benefit from this lowering of the expense ratio is actually investors like you and I. So because of this lowering of the expense ratio, now Nikko AM, it has a slight advantage. And I've also included the tracking difference of these two ETFs. So you can see over the past 3 years, Nikko has actually done a slightly better job at tracking the performance of the Straits Times Index. So one thing that the SPDR ETF is better at compared to the Nikko is in terms of its liquidity. Much higher trading volumes, much narrower bid-ask spreads. But all things considered, I do think that the Nikko ETF has a slight edge compared to the SPDR, which is why for this year, we have changed our recommendation for Singapore to the one by Nikko. Okay, so there are actually many other ways, more than just the 3 ways that I have shared today, to make use of our ETF focus list, which makes our focus list actually a very good starting point for investors who are just looking to build a diversified portfolio that gives them exposure to global markets. So after my sharing, please go and check out our ETF focus list if you haven't. Whether you are new or a seasoned investor, I believe that our ETF focus list can provide some value and guidance for your investment journey. And with that, I end my sharing today. Thank you so much for your time.